wealth builders. You're listening to Wealth Building with Options. Here's your host, Dan Passarelli.
Hello, listeners. We have got a special treat for you today. Before I introduce our thought leader guest, I want to apologize a little bit for my voice today. I have a little bit of an allergy thing or a cold or something, so my voice is not exactly how it typically sounds, but I assure you, the important person talking here, our guest, his voice is just perfect today. Let me introduce to you Mark Benzaquen. Mark is a principal at the Options Clearing Corporation, the OCC, in investor education. Please welcome Mark Benzaquen.
Hi, Dan.
Hey, Mark. It is so great to have you on the show. Thanks for joining us. I really appreciate it.
Yeah, my pleasure. Thank you.
Sure. So tell our listeners a little bit about your background and what you do over at the OCC these days.
Okay, certainly. I, like you, got my start at the CBOE, Chicago Board of Officers Exchange. I started in 1997 as a clerk, mainly in the OEX and SPX, so indice products. I was down there, kind of moved my way up into the brokerage side, where I spent the next 18 years or so filling orders in the NASDAQ and Russell trading pits. And then in 2015, as those products kind of fell out of favor with investors, they were really leaning more towards the S&P and some of the ETF products, et cetera. So my business as a broker kind of dried up. The stress, however, did not. And I felt that it was time for a change. I've always had an interest in education, and I actually thought about going to get my teaching certificate and ideally becoming a high school economics teacher. But I was lucky that OCC came knocking on my door, and I began with them in January of 2016. So it's just shy of 9 years now. And I am one of the four SMEs, the subject matter experts in our investor education team, where we provide education about all things options. We talk options all day long, which to some people might seem like a headache, and it's probably the last thing that they would want to do. But for option dorks like yourself and me, as well as my colleagues, it's a paradise. We love what we're doing. We love helping investors make sense of what it is that they're seeing and what's happening in their account, what's happening in the market, et cetera. And it's something that we do day in and day out.
Wow. So you survived on the trading floor a lot longer than a lot of some of the other folks, present company included.
Yeah, and honestly, I'm not really sure how that happened. I remember when I started down there, I was with a group of clerks. There were probably, I don't know, a dozen and a half of us. And I remember thinking, my God, these people are so much smarter than I am. And yet I don't know if I just flew under the radar, but yeah, I definitely had more longevity than, really any of my contemporaries that I started with. I think out of the 18 of us, there's probably only about 2 or 3, aside from myself, that are still involved in the industry. So, yeah, I don't know if I just got lucky or if I was, just so much of a non-factor that nobody even realized I was still there. Maybe it's somewhere in between.
Yeah, it's funny. A lot of the skills that we had on the trading floor, they don't really transfer into real life and
the real world, right?
Yeah. So many people that I know who I knew from the trading floor who were massively successful. They're like, what the hell am I going to do now?
Right. And that was kind of my thing when I left. I remember making a social media post, explaining that I was leaving the industry, or leaving the floor, I should say, and basically saying, I don't know what transferable skills that I have. I don't know what my next steps are. I've never been in a situation like this. And it was basically, now that I have to go out into the real world, what use will I be? So, I was thinking, well, maybe I do capitalize on my interest in teaching and my interest in education and my experience in finance. And like I said, I was very, very fortunate to have found this role at OCC. They've been absolutely terrific. I love what I do. And I certainly am more fortunate than I think I deserve to be.
And it's funny that you say out in the real world. I think everybody that I know from the trading floor says that, the real world.
Right. It's as far removed from the real world as can be. Other than being a rock star, yeah, I don't. There's nothing real world about working on the trading floor. And frankly, you know what? I'm so far beyond that now as a professional and as in my personal life. So I'm very glad to have left that behind. But still, it was while it lasted, it was terrific.
So now you're at the OCC, the Options Clearing Corporation. So what exactly is the Options Clearing Corporation? Like what is its role in the option trading ecosystem, and why do we even need such an organization?
Yeah, so the OCC Options Clearing Corporation performs or provides a number of services. So to begin, we're what's known as a CCP. And, as you know, and I'm sure your listeners as well, everything in this industry is an acronym. So CCP is a central counterparty. In that role, basically, OCC becomes the buyer to every seller and the seller to every buyer. So, for example, you and I do a trade, you buy an option, I sell it to you. OCC first makes sure that the money gets from your account to mine, and they make sure that my obligation to you is able to be fulfilled. If you and I do a trade and the next day I step outside and I get hit by a bus, and you decide that you want to exercise your contract, well, who's going to make good on that contract, with me laid up in the hospital? So that's where OCC comes in. They sever, for lack of a better word, the relationship between you and I and replace that with relationship with OCC. So now you have a direct relationship with OCC to make sure that the terms of your contract are fulfilled. And then I have a relationship with OCC to make sure that I live up to my obligation. So that's where the role of a CCP comes in. We are also known as a SIFMU, which is a systemically important financial market utility, which is basically the SEC saying to us that you are so critically important and integral to the function of the market that we are going to place so many more regulations on you and increased oversight to make sure that the industry functions as it does. And one of the ways that we ensure that is to make sure that our clearing firm members and our exchange partners remain solvent. We make sure that they've got enough, for lack of a better term, cash in the bank to fulfill the obligations of their clients. And we do that by margining them. If they've got an aggregate position worth, just off the top of my head, $8 billion, we make sure that they've got enough cash and collateral to support those obligations. So that's kind of what we do as a SIFMU. In addition to that, we've got this infrastructure system on the back end to facilitate the 11 billion contracts that trade annually, to make sure that everything clears properly, the exercise and assignment process, et cetera. So we are the people that nobody ever hears about. And that's kind of, what you want. You only hear about us if the system breaks. And in the 50 plus years that OCC has existed, we've only had one clearing member that has, basically gone belly up. So we've got all of these safeguards in place to make sure that everything runs as it does or as it should. And when we do our job, you don't even know that we exist. And that's kind of the whole point. So that's what OCC does. But in addition to that, they also feel that the industry needs to know what's going on. They need to know that options exist. So 30 plus years ago, the OCC and the exchanges got together and came up with a plan to really expand the awareness of the existence of options. And they created the Options Industry Council, or OIC. And that's where most of my efforts and my colleagues, that's where most of our efforts fall on, is that investor outreach, specifically of education, making sure people know that options exist, making sure that they know how they work and how to use them responsibly, what the potential risks are of trading options, certainly the potential rewards. And that's what we do on a daily basis. So we create content on our website, we do podcasts, online courses, webinars, et cetera. So we've got all of this content out there directed towards retail investors, directed towards the financial advisor community, et cetera. And it's basically, we just want people to know that options exist, how they work, and then whoever that end user is can make up their mind as to whether or not options are right for them.
Yeah, now that is pretty interesting because, as I understand, I mean, I don't think OCC, I don't think they really make a lot of money from providing education, right?
No, not at all. We all of our services are completely free of charge. So our department, our investor education department, is non-revenue generating, which, frankly, is kind of difficult when it comes time to, budgeting for the next year and asking for dollars to be allocated for what it is that we want to do, because we're not, turning those dollars around into more dollars. But that being said, our company, luckily our management and our, at the executive level, they do believe in the value of education. They feel that an educated investor leads to a better investing experience, and therefore people will hopefully trade options more. And every time that there's an options trade in the U.S. on the equity exchanges, for example, there's a clearing fee. I think it's 2 cents per contract right now. So that clearing fee is what goes to OCC, and that helps pay all of our salaries. That helps pay for all the innovation that we're doing behind the scenes, and that helps pay for the investor outreach that we do. But yeah, we're non-revenue generating. We're not technically a not-for-profit, but people kind of look at it as such.
Yeah, no. So you mentioned clearing fee, but earlier you mentioned that there are clearing members. Now, so how do they fit in with OCC and the rest of the options industry?
So the clearing members, those are the major trading firms for the most part. So you've got a trading account at XYZ brokerage firm. That brokerage firm is either a clearing member of OCC, or they are a subset of a larger brokerage firm who then is a clearing member of OCC. And so what we do, what those clearing fees do to, as I mentioned, pay our salaries, provide innovation, et cetera. But what OCC does with our clearing firms, as I mentioned, is we make sure that the safeguards are in place for them to maintain their solvency. So if you want to exercise your contract and your trading firm goes belly up, that doesn't mean that you lose out. Again, that's where OCC steps in. So we make sure that regardless of who you trade through, we make sure that your rights and obligations remain in place, again, through that central counterparty, that severing of the relationship.
Yeah, so I guess they're kind of like another point of accountability.
Oh, yeah, well, yeah, absolutely. Yeah, and the clearing firms also play a role in the exercise and assignment process, right? You want to exercise your contract, you notify your trading firm, or they do it automatically for you, depending on the type of option or how far in the money it may be. But then once OCC receives that exercise notice, we then randomly assign one of our clearing firms that has a opposite position to the one that you're exercising. So we facilitate the assignment process that way. Now, that clearing member then assigns one of their trading firms or one of their individual investors, depending on the structure, and they do that assignment through a process of their own, whether it's random or some other SEC approved process. But Yeah, that's kind of the other side of OCC, that exercise and assignment activity. That's what we facilitate. So, again, you're buying a call option, you decide to exercise it, and you want to buy that stock. We make sure that you have that ability and that the trade goes through without issue.
Now, you also mentioned the exercise assignment process. And man, this is one that people ask me about all the time. Like how does that even work? Is it like the person you traded with, you exercise it against that person, or is it random? I know a guy that I used to work with, Marty Kearney, used to say that they spin a big wheel and whoever it lands on, that's who gets assignments. I don't know if that's true though.
Metaphorically, yes. Literally, no, certainly. But yeah, we metaphorically spin a wheel to, see which one of our clearing members gets assigned. And remember, these are, some of the bigger banks and bigger trading firms, et cetera. And then that assignment notice goes out to that clearing firm. What they do with it is up to them. So, again, they've got some SEC approved process. It likely is a random assignment process, but it doesn't necessarily have to be. I think they have, last in, first out, something like that. But yeah, that would be in particular to that clearing firm. And then they assign a trading firm and they might have their own processes. So it's not as necessarily transparent as maybe it could be, but the OCC's role begins and ends at that clearing firm level.
Now, so you mentioned before sort of your draw towards education, but you've been doing this a long time. I mean, it's stuck for some reason.
Yeah.
Financial education specifically. So seems that there must be a good sort of match there, something, that near to your heart. So what specifically keeps you engaged and thriving in investor education? Like why is it become so important to you?
Well, the industry, even when I was on the trading floor, the life of an options trader, or in my case, a broker, and now an educator, it's almost like Groundhog Day, right? I mean, every day is kind of the same. It's certainly different because you never know what's going to happen with the market. We never know what's going to happen with, questions that we see coming in. And we respond to questions via email. We've got live chat on our website, which in the mix. But even though it's the same every day, it's also very, very different. So, I love that. I love the energy. I love you never really know what's going to happen. And I was very fortunate growing up that I had, some really terrific educators, some really terrific teachers. And then, in my professional life, I've always had terrific management, and they've always, gone out of their way to mentor me, gone out of their way to answer all of my questions, which are, thousands a day. But that education bug, really stuck. Plus, according to my wife, I love to hear the sound of my own voice. So nobody likes talking more than I do. But that being said, for the retail trader, options aren't easy. They just, by definition, they're complex securities, complex products. And for somebody that hasn't been in the business for, 20 plus or 25 plus years, like you and I have been, it's hard to make sense of what's going on. And especially for equity traders that deal with a lot of corporate actions, whether it's a stock split or a bankruptcy or a merger, et cetera, they have no idea what's going to happen because it's not something that they experience on a day-to-day basis. And I talk to, traders that have been in the business for decades, and I get an email from them and they say, I've never seen something like this. And it's like a reverse stock split or whatever, or a particular merger, and they can't make sense of what's happening to their options. So I really take personal joy and pride in helping these people understand what it is that's happening to their trade or their position or their account or whatever, because it's their money. It's real money that they've worked hard for. And, now they're investing for kids' college education, they're investing for their retirement, their, whatever it may be, that if you don't understand what's going on, you really can get burned pretty significantly. So I really take joy in helping these people understand what it is that they're facing to hopefully, prevent those, third degree burns and, a call to the hospital. So yeah, it's something I really enjoy. Again, I credit it to, past teachers, past supervisors and managers, something that I love and I feel very, very fortunate to be a part of.
Yeah, it has been a special industry. There are so many good people in our business.
Yeah, and there's a lot of horrible people too.
Yeah, and you know what? Like the media will pick up on the horrible people and
Right.
like get the pitchforks, eat the rich, and
Yeah.
not everybody's necessarily super rich or anything. Not like they portray it on TV. And I don't know. I don't want to get on my soapbox when I'm interviewing you, but so many people like really don't understand the good that comes out of just the
Right.
existence of options, first of all, and how so many people in the industry like yourself and like me, like really see that value and want to share that value and help people use that value.
Right, right. Well, I mean, the famous saying back, in the news was, if it bleeds, it leads, and yeah, kind of the same thing in the finance industry, right? People are interested in, who's stealing from whom, that it's a rigged game and an uneven playing field, et cetera. Those are the things that people are interested in, but it's not always the case, and it's not usually the case. Yeah, there's a lot of good. There's a lot of good people behind the scenes. There's a lot of good people in the industry. And again, like I said, I feel very, very fortunate to be a part of it. And I hope that I can count myself as being one of those good people in the industry.
Yeah.
Because I've known a lot of people on the other side of the fence, and
Yeah.
I'm glad to have put them behind me.
Yep. Now, one thing too, when you were talking about just your role in education, when there's a weird split or something, communicating that to other people. And that is definitely one service of the OCC that I've used. A lot of times people come to me, like through my work with market taker mentoring, people would come to me and say, "Oh, Dan, I don't understand this split or, cash distribution. Is it a dividend?" And most of the time I just answer the question, but I always predicate it with, in the future or this time, you should always contact the OCC because they are the definitive source of exactly how it's going to be handled.
Right. Yeah. We are the group that decides how those contracts are going to be adjusted. Now, when I say we, I'm not meaning me personally or my team personally, but my company rather. But we publish on a daily basis. People don't understand that corporate actions, happen literally every day. And on our website, we publish information memos explaining how those adjustments will occur, whether it's a special cash dividend, a stock split forward or reverse, a merger, bankruptcy, things like that. Any time that there is a situation which warrants a contract adjustment, that's when OCC gets involved. We publish the information on our website on a daily basis. It's, actually updated all throughout the day. And these information memos provide an explanation as to how that adjustment is going to occur and why. But it's written more for, again, our clearing firms. So it's very dry and kind of textbooky almost, very professional. And it's not written in, conversational language or terms. And what all that means is, sure, you can go to the website and you can read the memo and you're still like, okay, I have no idea what that means. I have no idea what I had just read. So that's where we come in. People send us the email saying, I took a look at the memo. I can't make sense of it. Can you help me? And then we explain in, normal person speak, what's going on. And it's huge. I mean, I think it's a terrific service that we offer. Again, the fact that it's, completely free of charge, I think is wonderful because people do have these questions and we respond to hundreds of communications each and every month. I was just putting together a report for the month ending October and, we had 400 communications. So, 100 communications a week of investors saying what's going on. And that's where we come in. So we try to give them the information that they can use.
Wow. Now, okay, so with all this education, like teaching every retail trader and even advisors and such, right? Professional traders.
Right, absolutely. Yeah.
So teaching the entire industry options, I mean, doesn't that just sort of raise the bar for everyone? Doesn't it make it harder for everyone because everyone's smarter? Are options a zero-sum game? If one person wins, does another person have to lose?
Yeah, absolutely not. And it's funny that you use the zero-sum game phrasing because that's exactly something that I use. Options are not a zero-sum game. Just because you're winning on your end of, buying a call option, for example, doesn't mean that I'm losing on my sell side because you have no idea why I sold that option. Maybe I'm doing it to, hedge against long stock. Maybe I did a covered call option. Maybe I'm, hedging against my another long position. So, I may be winning on that long position, but I want to hedge it. So I sold you that call option. But yeah, it's definitely not a zero-sum game. It can be a win-win situation. And then you never know if you're trading with a market maker, for example. A market maker, as personally, you don't care if you're buying or selling. You don't care if you're trading a call or a put. To you, it's all the same. All you're looking for is that edge, right? If you've got the option worth $1 and somebody's looking to sell it at 95 cents, well, you go ahead or you got it worth $1, somebody's looking to, sell it at 95 cents, you're going to buy it, and you pocket that nickel edge and then you immediately trade out of it or do something else to lock in that position, lock in that nickel. So, all that goes to say is that we never know what the other side is doing in terms of what their motivation is, what their objective is. And frankly, it's irrelevant. It doesn't matter to me at all. From the retail investor standpoint, they differ from market makers because they're not looking for edge. They're looking for their forecast. They want to accomplish their objective. They are bullish. They want the stock to go up, something like that. Whereas the market maker, certainly couldn't care. So, a lot of people equate trading options to gambling. And I was reading one of your recent blogs where you were talking about in 2020 that, when the pandemic hit, all these people, now have an influx of cash, in their pockets for whatever reason, and they can't spend it because all the stores are closed. Certainly all, sports betting is gone because, there aren't teams playing. And we saw a influx of option traders, and traders and investors are two very, very different things. But we saw an influx in option traders, and I was in Asheville, North Carolina earlier this year for the options industry conference that we do every year. And I was speaking to this one gentleman, Steve Sosnick, very, very highly regarded in the industry. And he made the same observation that you did in your blog. But so that was kind of describing, why we have been seeing this increase in volume. I had mentioned earlier that, OCC clears about 11 billion option contracts a year, a record last year. This year, it looks like we're on pace for even more. So it's going to be another record. There are more people coming into the options ecosphere than ever before. And it's, for us, we feel that it is of the utmost importance for these people to understand what they're doing. Again, the difference between trading and investing. Sure, you could throw your dart at a board and say, all right, I'm going to buy calls on this. Or you could, monitor the Reddit chat boards and, see which is the meme stock du jour and, take a chance at that. but that's gambling. That's not investing. And what we look for is, we really want those investors, people that are in it for the long run, people that are in it with a forecast and an objective. We want to make sure that they understand what it is that they're getting themselves into.
So I think, in a previous life, I was an OIC instructor as well.
I do very, very well. And again, thank you for guesting on my podcast, recently. So yeah, I'm happy to return the favor.
Sure. And, I know back then, and I think it's the same now, the focus for education through OIC is on basically, like, I guess I'd say, how options work, as opposed to something like, if this moving average crosses over this one and the RSI is this, then make this trade.
Right.
So, like, it's kind of a different thing. Is it important to understand all the nuances that come into play with options, like to understand get under the hood, the nuts and bolts of how they work? Or, can a trader just, get the recipe, and if this indicator is this and that one's that, then make the trade?
Yeah, I mean, they can do both. Certainly, there's no one size fits all when it comes to trading. One of the things that we don't do is, because we are not registered advisors, we don't provide recommendations. We don't make recommendations. We don't provide advice. So we're not going to tell you if the Bollinger Band is here, it's a sell indicator, or if, the candlestick, shows here, it's a buy indicator. We don't get into any of that. What we get into is, if the market goes up and you're short, this is what could happen. We talk about, if you're trading an iron condor, here is ideally the outcome that you're looking for the underlying stock. And if it isn't, we talk about, what that risk might be. We talk about, if your position's going against you, what are some ways that maybe you can mitigate those losses and maybe turn that crown upside down, as they say. And then again, we talk about those corporate actions. So we don't tell people this is what you should do. What we do is we give them, pardon the pun, we give them options of different potential paths that they can follow, and then explain what those outcomes might be at the end of each path. And again, it's really boils down to making people understand what it is that they're doing, what it is they're getting themselves into. And we feel that when you have that balanced amount of education, then you can decide which is the best path for you to follow. Now, that being said, that's, it doesn't mean that an investor can't say, all right, I understand, kind of the basics of calls. So I'm going to go ahead and trade, buy some out of the money calls on, the meme stock du jour. It doesn't mean that they can't do that, and it doesn't mean that they can't be profitable, but it is unlikely that they will become a successful investor or a successful trader for the long term, unless they really know those nuances that you were alluding to, what goes into these strategies and what those potential risks are and how to manage those risks. To me, that's what makes a successful investor, as opposed to, again, closing your eyes and throwing a dart at the board.
Yes. As they say, the more you learn, the more you earn. Yeah.
Yeah, right. Exactly. Hopefully that is.
Yeah. So I'm sure when you're out teaching a class in person at like a trade show, or even online in webinar, whatever, you probably get a good feel for what typical investors know and don't know about options. What are some underrated things that a typical options investor doesn't know but should?
Good question. What don't they know that they should? A couple things. Certainly corporate actions. I keep plugging that. I keep hammering that home time and again when I talk to people, because they don't happen all that often, maybe for a specific security that you're trading. When it does happen, most people have no idea what to expect. So, understanding how corporate actions work and what the potential ramifications of that is one. Number two, I would think, is after hours trading. And this is something that we often get people saying, my short option closed out of the money. Let's say I had a call spread on or a put spread on, what have you. My options finished out of the money. I thought everything was going to expire worthless. And here it is Monday morning. And now I'm long stock that I didn't expect to. And the stock is now down $10. Or I'm short stock when I wasn't expecting to, and the stock's up 50. So investors don't understand, they think that, you and I are Chicago boys, so the equity markets close at 3 p.m. Central. A lot of the indices and some of the ETFs, 3:15 Central. A lot of investors think that, come 3 o'clock, if their contract is out of the money, they're safe and they don't have to worry about it. And that's certainly not the case, because, an option buyer has the right to exercise at any time for any reason up until their contract expires, or more accurately, up until the exercise window closes at their trading firm. Now, what that means is that if in after hours trading, some news comes out, an earnings release, we've got a lot of earnings coming out this week, for example, that if there's movement, after hours movement in that market, it might turn your out of the money contract in the money. And you won't realize that you're getting assigned on that, which you didn't expect, until it's too late to do anything. And what I mean by that is, let's say you've got a spread on, both legs expire out of the money. So your long contract is going to expire unexercised because there's really no point to. Your short contract you're expecting to expire unassigned. And again, Monday, that after hours movement, now it puts both legs in the money. But because the long contract already expired out of the money, that isn't going to get exercised unless you explicitly direct your broker to exercise that contract. Your short option, you really can't do anything about it. You're just kind of waiting for assignment, or you're expecting it to expire out of the money and worthless. But the point being is, come Monday morning, if you didn't take any action, now you're sitting with a position that you didn't expect. So it's, back to the point of your question, that people don't understand that, once that closing bell hits 3 o'clock, that's not the end of the game. And you still need to be cognizant of potential risks that might occur due to that after hours trading. And as you know, that's a reason why a lot of investors close their short positions prior to the close of business. You might have a contract that's far out of the money, maybe not far out of the money, but you've got a short option that's out of the money that you could buy back, a few minutes before close, for pennies, or a nickel. And it takes all of that assignment risk off the table. And so I'm finding that some investors that maybe should be looking at the possibility of closing out those contracts ahead of time, at least that short position, that they don't. So I would say that that's a mistake that some people make, is not closing those out ahead. And there was one other that I had off the top of my head, and unfortunately at my age, it goes in my head just as quickly as it goes out. So if it pops in again, I'll remember to bring that up. But yeah, I think those two generally are some big things. And then not fully understanding more complex positions. If you're trading an iron condor, for example, or an iron butterfly, those are, two popular selling strategies that investors use, but there's 4 legs to them, right? And I kind of equate it to the difference between a bicycle and a motorcycle. If something's wrong with my bicycle, there's not many things that I need to look at. Is the tire flat? Did the chain fall off? Are the gears stripped? What have you. But if it's a motorcycle, that's got so many moving parts, it's going to be really hard for me to diagnose the issue. And kind of the same thing with options. It's a lot easier to manage a long call option than it is managing a 4-part complex strategy. So investors really need to have an idea of how to manage that position should things go south. We used to have the saying on the floor, plan the trade and trade the plan. And that's something that I think a lot of investors don't do. I think they just find something that they like and they think might have a little, movement either up or down, and they buy a call or they buy a put or, sell a call, sell a put, what have you. And that's kind of the end of it. But they're not as familiar with the mechanics of more complex strategies that, maybe can reduce the risk, or, when it comes to a bull call spread, for example, that gives you the ability to participate in upward share price movement. What are the chances that the stock's going to go from 50 to 5,000? Probably, a very low probability. So why pay for all of that opportunity for the stock to go to 5,000 when in reality it might only go to 52? So you can sell a call option to encompass that more realistic and more accurate forecast, and at the same time collecting some premium from the sale of that option. So now you're paying less for the spread, you've got less risk on, et cetera. So, there's all these different ways aside from just an outright buy or sell that I don't think people are really taking into consideration, and maybe they should.
Man, that is great stuff. That is gold. Thank you. I have been writing a lot about the wheel strategy lately, as our listeners are intimately familiar with. Covered calls,
Yeah.
cash. Yeah. Covered calls, cash secured puts. And, there's been a fair amount written on them in the past, but I've had the experience of getting feedback from a lot of investors who really struggle with the wheel. So I wanted to address that head on and explore why it doesn't work sometimes and what investors can do to improve the chances of it becoming a wealth building activity for them. So I have two questions for you. First, is this the type of investing system that can fit into a lot of individual investors' trading plans? And second, what kinds of struggles have you seen investors have with covered calls or cash secured puts? And, is there anything they can do to fix them from your point of view?
Yeah. So first question, is it a trade or is it a system that can fit into investors' strategies? 1,000% yes. A covered call is one of the most popular strategies out there. And if you get assigned on that covered call, you're selling your stock. So you get paid your strike price times 100, assuming it's a standard equity option, and you sell your stock. Your stock gets called away. For the beginning investors, to them, that seems frightening. I don't want to sell my stock. And our point is twofold. Well, number one, then maybe you shouldn't have traded this strategy. If you're absolutely adverse to getting rid of those shares, then this isn't the strategy for you. But that more realistically is, why aren't you willing to sell your shares? If I own stock at $50, there's got to be some price at which I'm willing to give these away. And whether or not that price corresponds with a premium that is advantageous for me to sell is a different story. But so that's kind of the first step. You own 100 shares of stock, sell a call against it, get a little premium income derived from that sale of the option. If the stock price eclipses that short strike, typically at expiration, those shares are going to be called away. Now you've got that cash in your pocket from selling the stock. Well, what do you do with that cash? Typically, you look towards another investment. That's where the cash secured put comes in. I'm happy to buy this stock back, but I'd like to buy it at a lower price. So I sell an out of the money put. And if I get assigned on that out of the money put, now I'm buying that stock back, et cetera. So that's the wheel strategy. I used to call it the rinse and repeat strategy, but unfortunately my phrase never picked up steam. Nobody tried to trademark it. So the wheel strategy is definitely more popular, and it makes sense, right? Because you sell a covered call, you get assigned, you sell a cash secured put. You sell a cash secured put, you get assigned, you sell a covered call, and you just keep doing it. And the idea is that you're just constantly generating premium income. I call it premium income as opposed to income because it's not a steady paycheck. but that income is coming from the premium that you receive when you sell those options. So the short answer to your question, which I should have got to, probably 20 minutes ago, again, remember, I love talking and I love to hear the sound of my own voice, is yes, it's a very popular strategy. Now, again, we don't provide advice or make recommendations, so I'm not going to say that it's something that everybody could use. Every investor has their, different risk tolerances, different level of investing sophistication, et cetera. But both strategies are very, very popular, very widely used in the marketplace. Now, that being said, what struggles do I see, aside from the unwillingness to actually sell the shares that you're obligated to if you get assigned on the call? Early assignment with a covered call is something that, people struggle with, that they don't expect. Early assignment is, just as it says, you're getting assigned on that contract prior to the expiration date. Remember, a buyer of a call option can exercise at any time for any reason. Now, there's usually not a lot of reason to exercise a call option early. One of the main reasons that people come across is when there's a dividend in play. And now, if you remember, well, you as a market maker certainly does, but for your listeners, buying a call option gives you the right to buy the stock. It doesn't actually buy that stock for you. So because you are not a shareholder, and this isn't directly related to the covered call, this is just the call option. But that, as a shareholder, you're entitled to certain rights, one of which is a dividend. So if I'm buying a call option, the only way for me to capture that dividend is for me to exercise that call. So getting back to the covered call, you as the investor, you're long stock, you're short the call option. I'm on the opposite. Maybe I'm short stock and I'm long that call option. If I want to capture that dividend, I've got to exercise my call, and I have to do it prior to that ex-dividend date, because that date is the date upon which the stock itself trades without the dividend attached to it. So I'm going to exercise my call early. You sold me that covered call. You're going to receive that assignment notice. And those shares that you have in your account that you were expecting to receive the dividend, well, those are now my shares. And now I'm getting that dividend. So one of the struggles that a covered call seller might have and come to terms with is getting that dividend paying stock taken away. So again, it comes down to managing that position. Being an option trader isn't the same as being a stock trader. I've got plenty of stocks in my portfolio that, as Warren Buffett said, I basically just put in the drawer and I forget about it. I just let those marinate and hopefully germinate and grow into not necessarily more stock, but more valuable stock. But that being said, options aren't like that. Options, you are, as an option trader, as an option investor, you are an active participant. You're looking at this position every day, several times a day, in certain cases, and you are actively managing the position. What's going to happen next? What's going to happen with the market tomorrow? Is there a dividend in play, et cetera? You're hands-on, right? Hands-on versus hands-off. So with a covered call, you've got to be prepared for these inevitabilities or potential inevitabilities, which, now that I hear it, sounds like an oxymoron. But you've got to be an active participant. So you've got to be looking to see what's going on and having a plan. Again, plan the trade the plan. Have a plan for, what happens if this does occur? What am I going to do? How am I going to react to this? So these are all things that I think a lot of beginning investors don't really take into account, and they should, and that can certainly happen when they trade this wheel strategy. Just to add a little, second part, that kind of addresses some of the things to the covered call, but the cash secured put, stock's trading $50, you sell a $48 put. What happens if stock goes down to 40 or 30? What happens if the company, gets delisted or is, going to pursue a bankruptcy? What's your plan to own stock at $50 when it's trading 20 in the market? Again, these are all things that you need to be prepared for, at least, or at least have an idea of what am I going to do if.
Oh yeah, I am a big proponent of just getting that mindset correct, getting your objectives set going into it for sure.
Yeah, I mean, as a professional trader, when you were on the floor, what's the hardest trade that you've ever made? It's probably locking in a monster-sized loss. But knowing that if you don't close out that trade and lock in that loss, it can grow infinitely bigger. So, again, these are all things that traders have to, have in their mindset of, believe it or not every trade is a winning one. Just like all of my jokes aren't winners, all of my trades aren't winners either. And we need to be prepared for that inevitability that should things go south, what is it that we're going to do to, again, try to turn that frown upside down?
Yeah, very few of my jokes are winners.
Yeah, agreed.
So when I was writing up my list of questions, I was thinking that you might be a really great person to ask this of. Can you share any demographic type data on option traders that our listeners might find interesting? Like, maybe what areas have the highest concentrations of option traders, or is there a certain age group, or even something in a different vein that you've come across that might be fun to share?
Well, that's not really data that we collect, and we certainly don't monitor it because that's not data that we have. But what I can tell you is, for example, our webinar program. We do an OIC webinar twice a month, and we do surveys at the end of it. So some of the data that I do have comes from that in sense of demographic, age of people that attend our sessions, their investment sophistication, beginner, intermediate, et cetera. That being said, we get generally in the neighborhood of about 1,000 registrants per event, and the demographic skews older, generally 55 plus. A lot of them are retirees, and a lot of them, for example, trade the wheel strategy because these retirees, these older investors have already amassed a stock portfolio. And so this is a way for them to, as my old boss used to say, squeeze out a couple extra shekels, in that stock if it's not performing the way that you want. So traditionally, investors are skew older. We do get a lot of beginners checking out our content. But as you had mentioned in your blog, there is a younger demographic that's entering into the space. And, we attribute a lot of that to the meme stock frenzy. A lot of people are realizing that you could leverage your investing dollars using options and get some pretty terrific payoffs. At the same time, you can lose everything and even more depending on what strategy that you're doing. That's something that I find, and just volume. I mentioned that, we've got 11 billion contracts we cleared last year. When you and I got into the business in the, mid to late 90s, I think volume was maybe a several million contracts a year, and then to tens of millions, and then hundreds of millions, and now we're in the billions with a B. So, more people over the last 24 years really are getting into the space. A lot of those are a younger demographic, certainly within the last, several years, the last 5 years, probably since COVID, as you had mentioned. But I think and again, this is just my opinion, I think the bulk demographic skews older. Again, they probably find a few strategies that they like. They're not running the gamut from synthetics, trading synthetic positions and ratio spreads and et cetera. What we tell people is that it might be good to have a couple bullish strategies under your belt that in and out, a couple bearish strategies that in and out, and mix those up between buying and selling. That if you have just a handful, a half a dozen or 8 or 10 strategies that you're intimately familiar with, how they work, what the risks are. It's both sides of the coin, bullish and bearish, both sides of the coin, buying and selling. That if you have those, that's should be a good place to start. And you may want to stay there. So, they're not looking at the more advanced spreads. They're not necessarily looking at some of the more advanced concepts on volatility and the Greeks and et cetera, et cetera. They're just looking at what they know. They kind of stay, that's their sweet spot. If it works for them, if it ain't broke, don't fix it, right? Something like that. And that's what's worked for them. You and I both go to, conferences and trade shows around the country, and we talk to retail investors, and a lot of them say, this is what works for me. And that's what I've been sticking with for the last 20 years. So there's no need for them to look at, something more complex. But what works for them may not work for me or work for you. And so, we look to something else. But you don't need to know everything necessarily. The more you know, as you mentioned, the more you learn, the more you earn. But education is never a bad thing. It's never bad to have too much knowledge. Maybe there's not such a thing as too much knowledge. So I certainly have seen people let it get in their way. But options are complex products, but they don't necessarily have to be. So if you find something that works for you, couple bullish strategies, couple bearish, buys, sells, know them intimately, and definitely a good basis for hopefully a successful trading and investing opportunity.
Excellent. Excellent. So we're getting into the end of it here. You mentioned trade shows. And we used to run into each other at these events and, shoot the breeze about what concerts we're seeing or whatever all the time.
Right.
Always fun.
Yeah, I know. We are avid live music lovers. Yes, absolutely.
Right. But do you have any good concerts lined up between now and the end of the year?
Not actually. My wife and my daughter are en route to Indianapolis as we speak. They're going to Taylor Swift tonight, and we just found out that they have floor seats, so they are losing their minds with excitement. There's a band that we like by the name of Dawes, Dawes. We saw them over the summer at Red Rocks in Colorado. My first time out there, and just absolutely loved it. And I've liked the band very much for a while. So they're playing in a couple of weeks in Chicago. So we'll be checking that out. We've got Oasis tickets for next summer. But that's it for now to the end of the year. We're starting to look at our 2025 concert calendar, seeing who's going to be coming around. Definitely another trip out to Red Rocks is going to be in the books, depending on who's there. I was fortunate enough to catch several shows at the new venue in Vegas called Sphere. So a bunch of shows, U2 and Dead and Company. So I'm excited to see who's going to be coming to them next year, because it's an amazing venue, unlike anything I've ever experienced. But generally, the 2025 concert calendar is going to unfurl, as 2025 unrolls. So we'll see, who's going to be hitting the road next year, and hopefully we'll catch some great shows, and hopefully I'll see you at some of them.
Oh man, I'll tell you what, the Sphere, it was freaking mind blowing.
Yeah, it was great. Yeah, I caught 4 U2 shows and then the one show for Dead and Company. I was in Vegas just a couple of weeks ago when the Eagles were playing. Decided to take a pass on that, though I'm sure it was terrific as well. So yeah, I'm excited to see who they've got slated for next year. We'll see what happens with that. Sadly, going to a concert in Vegas, aside from the price of the tickets, it's expensive, right? You've got a plane to pay for, you got an airfare, you got hotels. So it's not like, you and I, trucking up to the city to Salt Shed, to see somebody. So yeah, we got to take that into consideration too. My concert dollars for the last couple of years, I blew my budget, by exponentially. So we're going to try to keep that in check this coming year, but who knows?
Easy to do.
Right. Absolutely.
All right. Mark Benzaquen, thank you so much for sharing your thoughts. This was really super informative, really, really great. Thank you so much for spending your time with us and sharing your thoughts with our listeners.
Yeah, Dan, thank you so much. Love to talk to you, and thanks for this. It was a lot of fun.
All right. Until next week, trade smart.
Options involve risk and are not suitable for all investors. Before buying or selling an option, read characteristics and risks of standardized options. A link is provided in the show notes. To learn more about your host, Dan Passarelli, please visit markettaker.com.